Hope everyone's doing well. This is the Emini end of day review for Tuesday, July 30th, 2024. Before I get into today, I wanted to mention something about yesterday, and that is when I look at the daily chart here, I look at the extended hours, the overnight session, the Globex. The reason for that is because there's just less gaps. It's easier on the eyes. So if we look at the day only session, you can see it's a little bit different, more gaps. And something that was significant that I didn't notice until this morning was we actually had consecutive inside bars on the daily chart. But when we look at the extended hours, you can see over here, yesterday, Monday, went above the high of Friday, but this is the extended hours chart. So again, if we think about the day only session on the daily chart, what we have here, consecutive inside bars. Friday was inside Thursday, Monday was inside Friday. So consecutive inside bars, that is an II pattern, which is really just a triangle on a smaller time frame, which I'll show a little bit later. But basically, there's the triangle, you're getting lower highs, higher lows, the market's contracting. So when I saw that, I realized there's an increased chance. Well, there's just one other thing. Look at the daily range here, 44 points. We've had 100-point days, 90, 100. So we've gone from range expansion to range compression. So I thought with the consecutive inside bars, plus the bar being small, there was a greater risk of an outside day today. With that said, it doesn't matter really which chart you look at. The stuff I'm talking about applies to either chart. The main things, which is that we've had this bull channel on the daily chart, pretty tight bull channel, and then a trend line break with momentum, good for the bears. 2 legs down, and after 2 legs, maybe we're in a trading range, but this is tight enough, and it's pretty major. But we may need to get a retest of the bull trend's high, whether that's a higher high, a lower high, major trend reversal, and then the bears might try to go for a major trend reversal attempt and get a bear trend. But for now, here's what we have. Bear breakout, pull back, another bear breakout. So 2 legs down, and then 3 bars sideways. We know how sideways these bars are when we look at the lower time frames, whether it's a 30-minute, 45-minute, or even the 5-minute chart. Lots of trading range price action in here. So I thought the odds were there were buyers below yesterday's low, but Thursday's close is a magnet. This sell-off was strong enough. You had bears selling the close here. This is the close of Thursday, trapped on Friday. The odds were we'd come back and test this close. I didn't know if it'd be today or in a couple days or even in a couple of weeks. The odds were we would test this close and that close would be support. So if we sell off below this bar, it's a weak sell signal bar, consecutive bull bars or bull closes, low one short but 2 legs down with support below. The odds were we'd rally or at least bounce if we tested this close. And then just what I thought was interesting, when you look at the 5-minute chart coming into today, here's that II pattern on the 5-minute chart. You can see it's a contracting triangle with lower highs, higher lows. So the market's in breakout mode. And again, with yesterday's range being fairly small and a consecutive inside bar, there's an increased chance that breakouts of the high and the low of yesterday would fail. So here we are coming into the day. Yesterday's high, blue, and the low in blue as well. So coming into the day, we have trading range price action. We have a gap up and then a bull bar on the open. But look at the bull bar. It's a doji, not a very strong bar for the bulls. The bulls can argue there was a gap up and then minimum follow through, and that's true. We'll probably go at least a little bit higher. But there's a real risk that we fail to break out of yesterday's high. That doesn't mean you blindly sell yesterday's high, because oftentimes you'll see a breakout attempt that rallies for maybe 5 or 10 points, maybe even more, and then eventually reverses. So it's better to wait for the price action. But we are expecting resistance at this level. So gap up and doji on the open. There's probably sellers above bar 1, but if we're so close to yesterday's high, that's a magnet. Bears would rather just sell at the high rather than above bar 1. And then bar 2, we rallied on bar 2. Bull trend bar, we're going at least a little bit higher. Bears probably uninterested, although we're high in a trading range, so we are in the sell zone. But again, with the magnet so close, pretty obvious magnet, yesterday's high, we're probably going to get there and see what's there. So as far as selling above bar 1 or bar 2, I think it's better to wait for the market to go at least a little bit higher. Bars 1 and 2, plus the gap up, strong enough rally, we'll probably get a second leg. And buyers below bar 2, it's a weak sell signal bar. 3, we went outside down, so the market rallied above yesterday's high, and then failed to break out, sold off, went outside down. So 3 is an outside bar, but it's the entry bar for the short below bar 2, which was a weak signal bar, and then bar 3 is a weak entry bar. Outside bars are trading range bars. They're expanding triangles. So typically it's better to buy below an outside bar and sell above an outside bar. If you're selling here, you're selling the first reversal after the gap up, micro channel since bar 81. And then 3 is a weak signal bar. Again, it's an expanding triangle. So if you're selling down here, you're selling the bottom of a trading range. We're expecting a second leg up, although the upside might be limited. It looks like bulls are uninterested in buying above yesterday's high, and bears are willing to sell. But for now, probably buyers below for at least a scalp. And bar 4, you can see we sold off and then pulled back, and the bar closed above its midpoint. So even though it's a bear body, it's a bull bar. Bar 4 is a high 1 at the top of a trading range. The odds are there are sellers above bar 4. If a bull bought below bar 3 for a scalp, hoping for a second leg up, bar 4 is a pretty disappointing entry bar. If you're buying below a bar, let me see if I can find an example. Even like 41 yesterday, if you're buying below a bar, you want your entry bar to be more like bar 41 with a big tail and then trapping bears below, and then you get a bull close. But in this case, the bar closed bearish and the context is bad. You're high in a trading range. So again, there's probably more sellers above. And then 5, we continued to the downside. I often mention this. You get a high 1 at the top of a trading range. It's so common to not get that high 1 triggered because traders are not willing to buy above here. Remember, the market will only go to prices where institutions are willing to buy and other institutions are willing to sell. So if it's a bad high 1, you're at the top of a trading range, consecutive bear bars, most bulls don't want to buy up here. And we're not going to go there if an institutional bull doesn't want to buy there. And in this case, we didn't go there. Now, there were bears who would sell above this bar, betting it's a bad high 1, they'll fade the breakout, but they didn't get the chance. And you can see bar 5 opened on its high. And there's a sense of urgency there. If a bear wanted to sell above this bar, they never got the chance. Eventually, they start chasing the market down. And if a bull bought the close of bar 2, and then maybe They're disappointed with bar 3. They scale in lower. 4 is disappointing. 5 is even more disappointing. The bulls might be getting trapped up here. Now we have 3 consecutive bear bars. It's a micro channel. Bar 5 is a bad stop order signal bar for the bulls, probably sellers above. And the context is good for selling above. Again, we're high in a trading range. 6 went a little lower and then finally pulled back. We have a bull bar. Closing there it's high, but the body is small. It's a lower low double bottom with bar 1. But buying above 6 is hardly better than buying above 4. Now, you can call bar 1 a high 1. We have a gap up, trading range bar, implied high 1, and then double bottom, high 2 above 6. But remember that high 2s, you want to buy high 2s at the bottom of trading ranges, or you can buy high 2s at the tops of bull trends. But in this context, we have neither. We're at the top of a trading range. So it's better to sell above high 2s in this context. So even though we have a bull reversal bar and a double bottom at the moving average, the odds are there are sellers above. And now we have a 4-bar micro channel. So again, for that reason as well, more likely sellers above 6. 7, we went outside down, fairly big bar, a little surprising. Bar 7 is often a report bar. There's some kind of news event. And as Al teaches, that's really unimportant. It's good to know that you might have news on bar 7, but knowing what the news is and trying to interpret it and trade based on it is not worth your time. There's always a bullish and bearish interpretation of news. So we went outside down, and bar 7 is an outside bar, just like bar 3, but these outside bars are different. Bar 3 is a trading range bar. Bar 7 is a trend bar. So as far as selling below 3, even though the context here actually made sense, usually not good to buy below an outside bar that's a trading range bar. But when you have an outside bar that's a trend bar and you're not at the bottom of a trading range, like here, maybe this is the bottom of the trading range. Let me draw it. If this is the bottom of the trading range, we have room to the downside. So some traders might sell the close of 7, even though it's an outside bar, because it trapped bulls. Bulls bought above 6, and they hardly were ever at a profit before there was a huge downside breakout. So we're probably going at least a little bit lower, even though we pulled back, and this is technically 2 legs down from the high of 3 to the low of 6. We pulled back, so that's leg 1, pull back, leg 2 on 7. This entire sell-off is tight enough that it's probably one leg on a higher time frame chart. So it's probably all one breakout, which could lead to a pullback and then a big leg 2 similar in size to this leg. So for now, nothing really to buy. Bulls can argue they'll buy the close of 7, and they'll bet that it's a climactic bar, outside bar, in a trading range, and they can scalp, maybe test the breakout point, the bar 6 low. But bulls who are buying here are scalping. 7, we're probably always in short with room to the downside, but overall trading range price action. One more thing we'll notice, or I mentioned it already, is that bar 2, if a bull bought the close of bar 2, they never had a chance to exit. The market never retested that price after bar 3, so bulls are trapped. And then again on 6, bulls are trapped once again. And then bar 8, we had this bull bar, but it sold off, closing around its midpoint. You can see where bar 8 rallied to. We did not quite get to the high of bar 6, where the stop order buy was. So bulls who bought above 6, maybe they scaled in lower, maybe they didn't. If they tried to get out at break even during bar 8, they didn't get the chance. So now we have bulls trapped here, bulls trapped here. And if we think about gaps, we think about the closes of bars, the bodies of bars. The close of bar 8 does not overlap the open of bar 6. So right now we have an open gap. So the space between these two prices is a gap, and there's trap traders. The reason I'm looking at bodies is because the line chart plots closes. So traders looking at the line chart, lots of institutions look at line charts. The line chart's a good tool to look at from time to time. You'll see there's a gap on that chart, even though on this chart with the bars showing the highs and lows of bars, there is overlap. This would be considered a body gap or a negative gap. Bar 8 is an inside bar, reduces the probability for breakouts, probably buyers below and sellers above. But these two bars are mostly sideways. In an overall sideways market, we're probably going more sideways. And then 9, we had another inside bar, consecutive inside bars, breakout mode. Bar 9 is a weak buy setup because it's still a tight bear channel. Even though it's 2 legs down, like I mentioned, it's a tight bear channel. It's a breakout on a higher time frame. 9 is a bear bar, and it's consecutive inside bars. The bull breakout is low probability. More likely will continue lower and maybe test the bottom of this trading range. But as far as selling below 9, also not high probability. 10, we went outside down. It's another outside bar that's a trading range bar. The market rallied above 9, and traders were not willing to buy, and then we sold off, but then the bear breakout failed as well. We now have the failed high 1 or high 2 above 6, and then a failed high 2 or high 3 above 9. So stop order bulls are not making money. And as I said, it's always in short. Although it's a trading range, usually better to think sell high, buy low. But if I had to choose right now, the market is probably always in short. We have a lot more bear bars than bull bars. Open gaps, trapped bulls above, and stop order bulls not making money. So probably going at least a little lower because bar 10 is a weak, even though it's a micro double bottom, maybe a double bottom, high or low here. It's a weak signal bar. It's probably sellers above bar 10, and then probably buyers below. But again, they may not come in until more obvious support down here. 11, we're going lower. It's a reversal bar, closed above its midpoint, but still not a good buy setup. So if it's not a good buy setup, buying above here with a stop order is a bad trade. Then it's a good limit order sell. You can sell above bar 11, betting that the lower low double bottom with 3 consecutive bear bars below the moving average will fail. This is a tight bear channel and will probably go lower. 12 remained an inside bar, and 12 basically the same deal. You can sell above the bar, but buying above is low probability. Some bulls will buy below 12, and they'll bet it's an inside bar, low 1, low in a trading range. Maybe it's a wedge. 1, 2, 3, nested wedge. 1, 2, 3 pushes down in there. Then an inside bar reduces the probability for breakouts. It's all true. There's arguments to be made. But my concern with buying is the lack of buying pressure, and we're probably going at least a little bit lower. So sellers above 12 and buying below 12 also not ideal. 13, we got a bear breakout bar, closing on its low or near its low, trying to break out below this trading range low. It poked below it but did not close below. But look at this sell-off. In this sell-off we have about 10 bars with only 2 bull bars. And it's tight. And like I said, whenever you have a tight channel, it's a breakout on a higher time frame chart. So we can get a pullback, but then we'll probably get a second leg down at a minimum. 13, probably sellers above. And as far as buying below, you can bet on the failed bear breakout, but it's a little risky based on the lack of buying pressure and how tight this channel is. There's a lot of momentum to the downside. 14 broke out to the downside and pulled back immediately on the same bar. But 14 is a bad buy signal bar. Also, when it comes to breakouts, distance is more important than the close of the bar. And you can see this bar is 8 points. So we fell about maybe 7 points below this trading range low, the low of bar 13. If a bull bought here, betting on the failed breakout, the market went against them for about 7 points, and then it rallied. So what we might have here, on a smaller time frame within this bar, is a breakout pullback setup. There actually might be more traders looking to sell on the close of 14 and above 14 than buy, even though it's a reversal bar, 3 pushes down. I keep saying it, but I can't say it enough. The channel is tight. We're getting a lot of bear bars, and the buying pressure is weak. And then just one more thing about gaps. I mentioned this open gap, and the market currently has an open gap with the open of bar 8 and the current price. We haven't had a bull bar since, or bull close. So now we have a couple of open gaps. Once you start getting a couple of open gaps, 2 open gaps, maybe 3, the risk is real that the market is in a trend. As much as this might look like a leg in a trading range, you have to be suspicious. And that's what small pullback trends are notorious for. Small pullback trends look like they're always going to reverse. They look like legs in trading ranges. So in this case, this looks like a bear leg in a trading range. The market's been in the trading range. It's kind of choppy. Sell climax, pause, sell climaxes, overlapping bars. But where's the buying pressure? You don't get open gaps in trading ranges. And in this case, we have now 2 open gaps in a tight bear channel. So the risk is real that this is a possible small pullback trend from the open. $15, we went sideways. It's an inside bar. 15 is still not a good buy. There's not enough buying pressure. The context isn't very good, even though we're low in this range. We've now broken out below. And typically when you get breakout attempts in trading ranges, the market's quick to revert back to the mean. So let's say somewhere in here is the average price. Maybe we use the moving averages. They're mostly sideways. And we can use that example over here. The market's above the moving average, goes sideways, and then we come crashing back down to the moving average. We fall below it, we come back. Above, come back. Below, back and forth. But now, why are we not snapping back to the average price? If the market's in a trading range, bulls would be eager to buy down here, and then the bears would no longer want to sell or no longer want to hold short. But whenever there's not a good reason to buy, or there's no reason to buy in here, then there's a reason to short or hold short. So in this case, as I've been saying, there's a lack of buying pressure. The channel is tight. There's open gaps. It's okay to be short. It's always in short. 16 rallied above 15. We had a micro channel since bar 10. So the first pullback was likely to fail and reverse, and that's what we got on 16. 16 is a low one, and it's a doji bar, 3 consecutive dojis, so not ideal for selling with stop orders, but it is a fairly strong breakout, especially if you consider it all the way from there. And then a low one after a strong breakout with open gaps. It's not the worst short in the world below 16. And you have to consider the possibility that this isn't the low of the trading range. The low of the trading range could be all the way over here. And I don't want to get too off topic, but it's important. The low of the trading range could be all the way over here. I actually want to draw some kind of support line. Let's say we can use the low of, that was Thursday, I believe. Look at the market since Thursday. Big up, big down, and then lots of trading range price action. So we've been in this upper range, but it's possible the market goes back and tests the bottom of the range. So I had this line drawn because that could be the bottom of a trading range. but it doesn't look like we're bouncing there. So we might have to test yesterday's low. Plus, you realize it's a consecutive inside bars on the daily chart. Increased risk plus a pretty small day. Increased risk, we have an outside down day. Or I should say outside day in general, but I say outside down because we opened near yesterday's high. We tested it pretty briefly, and then it immediately reversed down, and now we're getting momentum to the downside. Another doji on 17, so 4 consecutive trading range bars. The bears will see this as a bear flag. We're in a bear trend. We're getting lower lows, lower highs, tight bear channel. Now we're going sideways, but the breakout favors the downside. The bulls, still really not all that much buying pressure. Where are the bull bars? There's really nothing to buy. If we think in terms of looking for major trend reversals, we need a trend line break, and we're also not getting a trend line break. So still okay to be short. 18, bear breakout bar, closing below all the bars to the left. Probably going at least a little bit lower, probably going to test yesterday's low. Bulls can argue it's 3 or 4 legs down. 1, 2, 3, 4. Maybe a sell climax on 18. But the bar is fairly strong, and we have a pretty obvious magnet below yesterday's low. So we're probably going to get there and see what's there. And then 19, a huge trend bar. Is 19 an exhaustive sell climax, or is it a measuring gap? We know it's one of the two. We know it's not a breakout gap or breakaway gap. It's not the start of the trend. The bear trend started up here on bar 3. We've had maybe, like I said, 3 or 4 legs down, consecutive sell climaxes. But the problem with seeing 19 as an exhaustive sell climax is there's a couple of problems with it. First of all, 19 is closing far below the channel line. So if this is the channel line, ideally you would see 18 and 19 stop here. Maybe go a little bit below, test yesterday's low. But 19 is a huge bar, closing far below yesterday's low, closing far below many, many bars to the left. Consecutive bear bars, so 18 was a bear bar, bear breakout bar, closing below a lot of bars. 19 is a follow-through bar, and a very strong follow-through bar. It's a bigger bar, small tails, big body. And the problem with this being an exhaustive sell climax is the lack of buying pressure. That's one of the issues. Remember, we have open gaps. This is a give-up bar from the bulls who are trapped up here. The market's probably going lower. So for me, I see this as more of a measuring gap. Also, we're not at any obvious support to the left. We're closing below a lot of bars. And so we're probably going to go at least a little bit lower. I just want to draw the measuring gap, measured move. I think that's a significant measured move level. And I'll do it this way. Actually, we could also, everyone draws it a little bit differently. It's not even all that important, but let's say we go from here. 18 and 19 is the breakout. We'll use this. We'll use that line for the measuring gap and be a little more conservative. So here's the measuring gap, measured move. Is there any reason to buy the close of 19? If you do, you're betting it's an exhaustive sell climax, but the context isn't very good. I think more likely we're getting a bear breakout of a tight wedge, and we're probably going lower. So if you do buy 19, your premise is that this is an exhaustive sell climax, kind of like over here, 25. You need your entry bar to be like 26. You need bears to get trapped who sell the close of 19. Immediately the market should go your way. And then look at bar 20. More follow through. Even though it's weak, it's technically a bull bar, closed above its midpoint. Another bear close. There's a huge gap or micro gap from the low of bar 18 to the high of 20. Lots of traders trapped in here. Bears who didn't sell, bulls who are trapped into bad longs. Everybody's desperately hoping for a pullback and any bounce so that they can sell. The bulls want to get out of their longs with a smaller loss, and the bears want to sell higher and catch the second leg. So for me, this leg, even though it's maybe 3-4 pushes down, this, you can consider it a surprise. Al might call it a surprise breakout of a bear channel. All you have to know is that surprises get second legs. And so this could be a leg count reset, a major leg one bear breakout. So it's just important to get short here. It doesn't really matter if you sell the close, sell the follow through bar, sell above the follow through bar, sell the pullback, the low of yesterday, breakout point. It doesn't really matter as long as you find a way to get short. Obviously, or bar 20, we have a reversal bar after 5 consecutive bars with lower highs. This is a micro channel. Strong bear breakout. Bar 20 is a weak buy setup. There's probably sellers above the bar. The sellers may not come in until the breakout point, yesterday's low. That's an important price. But we crashed straight through it. 21 rallied above 20, but then sold off and closed near its low. Trading range bar. Low one short. Fairly big bar, 10 points. Relatively big bar, even though 19 is about 20 points, 21 3/4. In here, 21 is a fairly big bar, and bears don't necessarily want to sell a weak signal bar that it has a big body, so bigger risk after a big breakout that's likely to get a pullback. 21 traders will buy below. Bears who sold this low tick of 20 or sold the close here, they're disappointed with bar 21, so they'll look to buy back their shorts and sell higher. Bulls know that, and they can buy for a scalp. They can buy below 21. They can buy the close of 21, looking for a scalp. However, most traders should be looking to trade in the always-in direction, in the direction of the major breakout. So here, really no great reason to look to buy. Better to be short or look to short. Bull trend bar 22, but it's an inside bar. And on a smaller time frame chart, we rallied on 21, pulled back, rallied on 22. So this is already 2 legs against a major trend. So more likely 22 is more of a sell the close bar, even though it's a good looking bull bar. Sell the close, sell above. The upside is probably limited. 23, we have a doji. Closed above the prior bar, but the prior bar was an inside bar, so breakouts are likely to fail. Again, this blue line is yesterday's low. And that's typically support, but in this case, we broke straight through it. If the market's trending, 80% of reversal attempts will fail. You can see here, we tried to reverse above, failed, here, and here. This doesn't look particularly strong. So we're expecting 80% of reversal attempts to fail, and when the market's trending, you're expecting, in this case a bear trend, you're expecting all the support to fail. So here's the support level, we broke straight through it. So the support, as it was support over here, becomes resistance. Bulls who bought the low of yesterday got trapped on bar 19. They're hoping for a bounce and a retest so they can exit on break even on that trade. But bears see a rally, a pullback, a rally, a pullback, a rally. This might be 3 legs up against a trend. After a strong bear breakout, we can actually look at it on a smaller time frame chart. And what we'll probably see is a wedge bear flag. I'm going to give it a couple more bars, and then we'll look back and see what it looks like. But for now, 23, probably sellers above, maybe buyers below for a second leg. You can argue we rallied from the low of 20 to the high of 23. Strong enough rally for a second leg. But you're expecting that second leg to be minor. This is a minor leg 1 breakout against a major trend. So buying here is dangerous. Better to look to sell basically for any reason. 24 rallied above 23 and reversed down, and 24 closed on its low. So even though on this time frame, this is technically the low one, we sold off and then we pulled back. This is the first bar. We actually haven't had a continuation yet. We haven't fallen below the low of a prior bar. This is a micro channel. This is a low one signal bar and a micro channel. 24 is a low 3. It's implied, like I said here, rally, pull back, rallied, pull back, rallied a third time. So we'll look on a smaller time frame and see what that looks like, but we're expecting to see 3 legs against the trend, and it probably looks like a wedge bear flag. 24, bear bar closing on its low, always in short, after implied 3 legs up. So 24 is not an ideal bar to buy below. It's better to get out of longs if you're long for any reason. In bears, if you're not short, you can sell below 24. More likely sellers below 24 than buyers. And then 25, we got a bear breakout closing below 24. And 25 rallied in the beginning of the bar, but did not get back to the high close of 23. So any bull who bought here, they're trapped. And now you have consecutive bear bars against you. Overall, bear regime, we're below the moving average. Lots of bars below the moving average. Major bear trend, probably going lower. Also, even at this point, or anywhere here, the odds that we've seen the low of the day are very low. When you have such a major breakout, you're expecting a pullback. Most breakouts pull back. 80% of breakouts pull back. So this is expected. But very often, you're going to get a second leg that extends at least one tick below, in this case, the low of the prior leg. So at this point, it's very likely we're going below bar 20, and then it's just becoming more and more likely. And at some point, the bulls will give up, and the bears will be short, and everybody's selling. And that's what happens on bar 26, another give-up bar. So we have a wedge bear flag, and that's another target down here. Other targets we could include, we could look at bar 19 using the body. That takes us between the measuring gap and the wedge bear flag. We could also look at the breakout and follow through, so that's bar 18 and 19. That takes us just below the wedge bear flag, but you can see all of these are in similar places. So we'll start with the measuring gap, measure move, and see it's the closest one. We'll see what happens when the market approaches it. But before we continue, I do want to look up to 1140. If TradeStation will let me look at the 100-second chart. So here's bar 24. It's very interesting. Here's the big bear breakout. And you can argue it's climactic, but think about it. If a bull bought anywhere, you bought below here, betting this is a trading range, so you buy here, or you buy below any bar, buy for any reason, you're just getting squeezed. The market's going lower and lower. You're never getting a chance to exit. That's a strong breakout. It's probably getting a second leg. Then look at this rally. 1, 2, 3. The push is getting weaker. This one, strong enough for a second leg, but the second leg had overlap, and the third push was even weaker, subdivided into 2 smaller legs, and it's the smallest of the 3. So more clearly on the 100-second chart, it looks like a wedge bear flag, and then continuation, traders sold below 24. So I thought that was interesting. So we have a give up bar, 26, probably going lower. 27, we're going even lower. Now this breakout, even though you could pretty clearly call it leg 2, leg 1, pull back to leg 2, this leg is strong enough, this breakout is strong enough, that it's probably going to get a second leg of its own. 27 is a weak stop order buy. There's probably sellers above. And again, sellers above for a second leg. Maybe we'll test the bar 20 low, that breakout point. but the odds are any pullback will be minor. Inside bar 28, actually might not be an inside bar. My mistake. We have a bear breakout that pulled back. We're getting close to the measuring gap measured move. Oftentimes the market gets close to a measured move, pulls back, and then gets there. You have traders front running the profit taking, maybe nervous we're not going to get there. They take profits early, but then the reversal is minor. Bulls are scalping, they start selling, the bears start selling, or they're already selling, and then we get to the measured move. 28, 5 bar micro channel, weak signal bar for buying, probably sellers above. Going lower on 29, but now we have consecutive dojis. On a smaller time frame chart, this is a spike in channel, bear trend, so I think at a minimum, we'll probably go at least a little bit lower, but we could come back and test the high of bar 28. Still nothing to buy, so okay to be short. We are obviously reacting to this measured move. The market, the momentum is slowing down. We're going sideways, buyers below bars, but bulls buying below bars, hardly making a profit. So still always in short, no real reason to buy. 30 bear reversal bar. The micro channel is continuing, and we're testing the measuring gap measured move. So that one has been reached. So we'll go ahead and add the next one. So the next one we'll look at is the bar 19 measure move, which is here. Not very far, we're probably going to get there. No buying pressure, but we could bounce before we get there. 30 is a small bar, again small spike in channel, so buyers below bars, but minor. Outside bar 31, finally got a pullback, and then this outside bar is an expanding triangle. Probably buyers below, but still minor, no reason to buy for a swing, and still okay to hold short. 32, we had a bull trend bar. 32 is a strong enough bar that you expect a minor second leg, but there's a couple problems with 32 here. One of the problems is that 31 already rallied and then sold off, so this could already be a second leg. Rallied, pulled back, rallying again. And then you have the overall context. This is a minor reversal. Remember I said with major trend reversals, you need a trend line break. This is a tight bear channel, and there's no significant trend line break at this point. It's a good looking bull bar, but the bulls haven't done enough. However, this might be strong enough that the market's in a small trading range here, and there's buyers below 32 and 31. Plus you have the bar 19 measured move target, so there's a couple of reasons to expect buyers below here. But 32 is mostly due to bears taking profits and not bulls aggressively buying. So as strong as 32 looks, it's a bull bar in a bear channel, and in bear channels, bears sell rallies, so it's more of a sell the close bar and sell above. 33 bear bar, disappointing follow through for the bulls. High one, sellers above, probably going lower. 34 sold off and pulled back, so now we have one leg down, pullback. We're probably going lower, but again, probably buyers below the measured move target, and 32 was strong enough to get a second leg. But oftentimes, in a context like this, the bulls don't want to buy up here or even a 50% pullback of the bar. They'd rather buy below the bar or below the entire trading range and get a deep pullback and delayed second leg. 35, strong bear trend bar, but could be exhaustive. Now we have two legs down. 33 sold off to 34, pulled back, and now we have a second leg down. This is also very subtle, and this comes with just experience with chart reading. You have a trading range bar, an outside bar, 31. After a couple legs down in a trend near support, measured move target, and then you get the bull bar, 32. So at this point, the market might be in a trading range. We've been sideways for about 7 bars. And then you get this sell-off down to 34, a pullback, and then an even stronger bar, 35. That's characteristic of a second leg trap in a trading range. So even though at this point the market is still in a bear channel with lower highs, lower lows, 35 might be more of a buy the close bar, at least for the short term. Now the market's in a bear trend, and traders can sell for any reason, use a wide stop. Your stop goes above the last major lower high, which could be 24, but at this point 35 went to a new low, so you could even put your stop above 33. This is a major lower high if a bear breakout to a new low. But again, 35, we're at a measured move target. We're below this bull trend bar, likely buyers below for at least a scalp, and then a climactic bar, 2 legs down, which again we might look at on a smaller time frame, might be a second leg trap. And you can see what happened on 36. Bull trend bar, 36, 2 bar reversal, completely reversing 35. Bears taking profits and bulls buying for a scalp. So this bull breakout got a deep pullback, 2 legs, and then is getting a second leg. 36 is strong enough for its own second leg. It's a double bottom, but this is still a minor reversal, even though it might look like a wedge. 3 pushes, 1, 2, 3. A couple of good bull bars. The buying pressure still isn't enough. There's still no major trendline break. So even though 36 looks like a good bull bar, it's really not ideal to buy above. Bulls will buy a pullback and they'll look to scalp, but we also have been below the moving average for over 20 bars, and we're still fairly far below it. So we might come up and test it, but the odds are there are sellers above. That's also the problem with putting your stop above this major lower high. If you're still holding short, it's probably better to put your stop above 24, because if your stop is here, the market is still in a channel, still always in short, and this might be a trading range. The odds are there are sellers above at the moving average, above this swing high. So if you're short with a stop up here, this would be a skunk stop, and you'd be you'd be buying back your short exactly where the strong bears are selling and the strong bulls are selling as well. 37 pulled back for the bulls. Here's a breakout, pullback, maybe 50%. We are expecting a second leg. Bears would rather sell higher. But it is a bear channel, so bears do sell rallies. So there's a rally 36, bears sold it. But this is disappointing. It's half the size of the prior bar. So we might get a second leg up that bears would prefer to sell instead. Maybe a test of the high of bar 33. Then we went outside up 38, which could be a second leg trap. We rallied, pulled back, rallied again with an outside bar. That's an expanding triangle, high in a trading range or bear channel. So 38 is more of a sell the close bar, similar to 32. And bears can sell for any reason. It's still a bear channel. You're getting 2 legs up, high in a channel. So a reasonable place to sell. And then 39 remained an inside bar. We tested the high of 33, but did not quite get there. Now we have a nested low 2 short on 39. On a higher time frame, it's a low 1 below 33, and then a low 2 below 39. But then even here, it's a low 1 below 37, low 2 below 39. Low 2 and a bear trend. Remember what I said about the high 2 earlier? This is a high 2, high in a trading range, so better to sell above. But a low 2, even though you're near the low of the day, this is a bear trend, so it's reasonable to sell a low 2, low in the day when it's a bear trend. So probably sellers below 39. 40, breakout bar. Not climactic, it's a strong bar, consecutive bear bars closing on their lows, probably going at least a little bit lower. Because we tested this magnet, we'll look at the next one, which there's all sorts of magnets you can look for. Maybe the breakout and follow through using bodies. So that's here. And then 41 selling off. That one actually tested it and went through it. And then what about the wedge bear flag? That also got tested. So the market's getting through more and more support. But this is a channel, so we have a spike and channel trend. And what do we know about the market cycle? You get a breakout, pull back, so the breakout phase, the channel phase, and then the market's more likely to convert into a trading range than breakout again below the channel and then convert into an even stronger bear trend. So the expectation here is that breakouts below the channel will fail and we'll actually get a test of the bar 24 high, because that's the start of the channel. And the start of the channel often becomes the opposite side of the trading range. So spike and channel, couple legs down, but getting more and more two-sided trading. And now we have a possible exhaustive sell climax. 41 is the biggest bar in a lot of bars. It's happening late, 3 legs down, lots of sideways here. That's a possible final flag. Maybe it's a triangle. Different ways to look at it, but tight trading range possible. Final flag, bear breakout, climactic. The bears really need follow through here. And they got follow through 42. That's good for the bears, but it's still not enough because the follow through bar is small. It's smaller than 41, and the context does not support a downside breakout. So more likely, this exhaustive or this breakout is an exhaustive sell climax where bulls are stepping aside. Bears will use this to take profits. We're at a lot of measured move targets. And we are approaching the low of Thursday. I drew that line. This could be the bottom of the overall trading range. So we might get a little bit lower. Consecutive bear bars, 4-bar micro channel. Probably sellers above for a second leg, but increased risk of a reversal when the context is late in a bear trend and you're getting the biggest bar late in the trend after 3 legs down and a tight trading range. 43 bull reversal bar. Not a high probability buy, probably sellers above for a second leg, but some bulls will take a chance. Betting this was a final flag will at least come back and test the bottom of this trading range. And then again, I have this red line, the start of the channel. That could be the top of a trading range. So at this point, the market might be low in a trading range. But the bulls are still taking a chance because we have open gaps. The close of 32 does not overlap the open of 21. And right now, the close of 43 does not overlap the open of 36. So still open gaps. But again, possible exhaustive sell climax and breakout attempt of the bear channel line, which has about a 25% chance of succeeding, and more likely will come back and test the trend line we will reverse within 5 bars and then test the trend line. And then 44 bull bar closing on its high. So with this being a possible exhaustion gap and then consecutive bull bars closing on their high, more and more bears will be willing to exit above 44, and more bulls will be convinced to buy above it. It's still not yet high probability, but it's becoming better for the bulls. We'll probably close this gap. That's the first target. And then we'll probably test the start of this last leg down, the high of 39. But also with the trend line, likely the breakout below fails and then we test the bear trend line. 45 more follow through, 3 consecutive bull bars. In this context, bears can get out of shorts above 44 or wait for 45 and then get out of shorts and then reassess. In bulls, still not a high probability trade, but getting better, 3 consecutive bull bars. They can buy expecting a second leg. This is strong enough for buyers below and a second leg up. 46 going higher, but it's a pause bar. Bears who sold down here, they sold the close of 42, they sold above 43. They're disappointed with the rally. And then we got a pause bar, 46, and they're wondering, is this all I'm going to get, or are we going to come back down? But if this is an exhaustion gap, we could easily just rally here and not look back. So bears, they might use this pause bar and exit. Bulls, they see the rally, they want to buy a pullback, but we're not getting one. So more and more traders might start to buy. Plus the trend line's right above, probably going to get there. 47, we tested the trend line. We tested the moving average for the first time in over 20 bars. So the expectation is sellers at the moving average will probably at least bounce and go a little bit lower. But it's 5 consecutive bull bars in a micro channel without a pullback. And so probably buyers below the first reversal. 48, we sold off and then closed on its high. It's a high one after a decent bull breakout. Context still isn't great. You want a trend line break, and we're not really getting a trend line break until here, and even this is very minor. But when you consider the spike in channel in the market cycle, it's possible, again, this was a climactic third push down, and we get a rally all the way up here to the top of this possible trading range. So it's okay if you sold down here and you're willing to use a very wide stop, scale in higher, you can sell up here. You'll probably be able to get out break even, and even at your original entry price. But this is too strong to be selling against. 49, another bull bar closing on its high, probably going higher, probably going to test the 39 high at least. But this is pretty sustained buying. The bulls are controlling price and time. So this is a major, it's a big minor leg one breakout, probably buyers below for a second leg. And then a give up bar 50. So bears were hoping all the way up this would get a second leg, but the market kept going against them more and more, and eventually they all gave up. And this is a give up bar similar to 19. 19 is more of an extreme example. But to me, 50 is the bears giving up, and now we have a measuring gap with bar 50. So it's the same thing as over here, but in the opposite direction. So here is the measuring gap, measured move. Sure enough, we're in the neighborhood of the start of the channel. Yesterday's low. They're all this cluster of resistance. So there's reasons for the market to get here. Probably a measuring gap, less likely an exhaustion gap. If this was occurring up here, that would be different. But because we're sort of in the middle of this range, with all this momentum, we're probably going higher, probably by the close. 51, minimum follow through, inside bar, but it's a bull bar, high one buy, probably going higher, buyers below. 52, rallying further. This is all a tight channel with the bars with significant overlap in prominent tails, but it's a pretty tight channel. It's a breakout on a higher time frame chart. Buyers below, probably going higher. Finally, a bear bar, 53. It's the first bear bar in about 10 or 11 bars. So bulls will buy the close, buy below. They'll buy the moving average test. Betting the first reversal attempt will fail and will rally further. And then consecutive inside bars, 54. It's a triangle, as we talked about. II pattern is a triangle on a lower time frame. So bulls will see this as simply a bull flag. Here's a bull trend. We went sideways, probably get the upside breakout. Bears are hoping for the opposite, that the II pattern is a final flag. Maybe we get the upside breakout and then reverse back down. And this is the trading range. Outside bar, 55. So the market tried both ways and failed, but the momentum is still to the upside. So with an outside bar, probably buyers below. You can sell above, but the selling pressure through here, not very strong. There's open gaps. We probably have to go higher to find sellers. 56, we're rallying further. Small bar, but that's good for the bulls. It's not climactic. It's a breakout bar, but they need follow through. And then they got follow through 57. So more and more traders might buy, bulls buying to get long, bears buying to get out of shorts. Leg one, sideways, maybe leg two, and then we're going to test. We're approaching these magnets above 57 is a weak stop order, sell for the bears. There's probably buyers below. And then we're rallying further, 58. Now 58 is a little climactic. It's a bigger bar. It's racing to resistance, but we still have a little more space to go. We're not quite at the high of 24 or the low of yesterday. So there's still reasons to go a little higher. But if we do get another big bar like 58 on 59, bulls might take that as a gift, as an exhaustive climax, and look to get out of longs. And then a pause bar. 59, you can see exactly where the market tested. We tested the start of the channel. So spike, channel, trading range. So now we're at the top of the trading range. This is expected to be resistance. The last time the bulls bought here, they got trapped. Now we rallied, but this is strong enough for a pullback and then a second leg. So this reversal could be minor. It's a weak signal bar to sell below, trading range bar, 5-bar micro channel, probably buyers below. The reversal, probably minor. Think about it again from the perspective of the major trend reversal. We need a trend line break, a test of the trend's extreme, and then we could look to sell. But right now, there's no trend line break. 60, bear trend bar breaking out, but breaking out of a trading range bar and a micro channel and a tight bull channel. So probably buyers below. 60 is a weak high 1, probably sellers above the bar, but buyers below. And this might get a second leg down. It could already be a second leg down. We sold off on 59, pulled back, sold off on 60, pulled back. Maybe we go a little lower, get a wedge, bull flag, and then rally. Inside bar, 61, probably buyers below and sellers above. Micro channel for the bears, but it's a minor reversal, counter trend, so better to look to be long or buy. However, you can argue we're high in the trading range. Better to sell above 61. It's a high 1 at the top of the range, and that's true. 62. 62 is a bull trend bar. So now we have a trend line break. Not very strong. The bulls can simply do this. There hasn't even been a trend line break. When you get a trend line break, you want it to be obvious. This is pretty minor with bad follow through, immediately reversing up. So it's a minor trend line break. But for this to be a major trend reversal, we need more selling pressure. We don't have it yet. We still have open gaps. The close of 61 did not get to the open of 53. So open gaps here, open gap here, probably going higher. But the upside is probably limited. This is probably the top of a trading range. I'm probably not getting far above the high of yesterday. High 1 buy above 62, strong rally. Probably going higher, probably get a second leg. This is all one leg on a higher time frame. But we may have to pull back and go sideways more first. Maybe leg 1, pause, leg 2. And then 63 could be the second leg for the bears, where this is leg 1. We pulled back. Maybe we go a little lower, below 63, but the odds are there's buyers below 63. 63 is an inside bar. The market is always in long. It's a weak setup for selling. It's a low probability sell, so small risk. Potential reward is huge. And whenever your risk-reward profile is fantastic, your probability is very bad. That's why you can go to the store and buy a lottery ticket for $5 to make $1 million. Your risk-reward is phenomenal, but your probability is terrible. 64, bear breakout, but now it's 2 legs down against a tight bull channel. So the odds are this is still minor. Now, it's a strong enough minor reversal that it clearly broke the trend line. Now we have a trend line break with momentum. But at this price, the bears are going to take profits. The bears will likely take profits. We're testing the apex of this II pattern. Remember, this was a triangle on a smaller time frame. And triangles are areas of agreement. As minor as it is, if we looked at a 30-second chart, there's a lot of bars in here. The market's in a tight trading range. So the bull breakout eventually came back and tested back to it. But this will also be support now because bears who sold here, betting on the bear breakout, maybe they got trapped on the outside down bar, 55. The market rallied against them. So what are they going to do on a 2-legged retest? They're probably going to buy. So maybe leg 1 for the bulls, 2-legged pullback, and then a second leg up. So 65 was bad follow-through for the bear breakout. Bear breakout, good-looking bar, but small tail below, could be better, and then no follow-through 65. 65 is a weak stop order sell, probably buyers below. It's not the greatest signal bar to buy above, and it's an inside bar, but the context makes sense. And then 66, we sold off below 65 and found buyers, and now 66. Consecutive bull bars with 66 closing on its high. Micro double bottom, it's a high too, and you could argue a bull trend. Overall, the market's in the trading range, so the upside is probably limited, but you'll have bulls buying here for at least a scalp, a test of the highs. You'll have bears stepping aside. They know that for a major trend reversal, you have a trend line break, retest. Bears want to sell up here. 67, maybe one more attempt for the bears, but now it looks like a wedge bull flag. 1, 2, 3. Bull trend, wedge, bull flag, probably at least some sort of rally, maybe 10 bars. We'll probably come back and test the high close of 58 at a minimum. Even though 67 is a weak signal bar, the context is good. You will have stop order bulls buying above. 68, we rallied above and pulled back. But now 68 is a weak low 2. It's a low 2 after 3 pushes down. In a minor reversal, the always in direction is still long. This is not always in short. So you have buyers below 68 betting on higher prices. 69, bear trading range bar, sort of a nested wedge, you could say. 3 pushes, 1, 2, 3, and maybe 1, 2, 3. Maybe it's a head and shoulders, left head, or left shoulder, head, right shoulder, head and shoulders bottom. Buyers below 69 for a retest of the highs. Bears don't want to sell down here. Consecutive sell climaxes add support. And then 70, a bull trend bar, probably going higher, closing on its high, closing above the past 5 or 6 bars. And the expectation is a test of the trend's high. But now this was enough damage by the bears that any retest up here will likely act as resistance, and then we'll just keep yesterday's low for that level. Breakout and follow through on 71. Small follow through, but minimum, probably going higher, buyers below. 72, trading range bar. Bulls see it as a bull flag. We have a bull breakout, maybe the start of a channel. Maybe we start to channel up here. 73, we tried to sell off, but it's a weak setup for stop order bears after a bull breakout low in a trading range. So buyers below. 73 is a high 1 after a breakout, probably going at least a little higher. Outside down, 74. Now it's 2 legs down, 1, maybe even 3, 2, 3. Buyers below, buyers on the close. Betting this is a wedge bull flag, even though it's very minor. Bull trend, and then a bull flag, bear channel, and then second leg up. 75, outside up, bull bar closing on its high, probably going to go higher. Bears, they'd rather sell high in the range and not above a bull bar closing on its high. 76, surprising bar, huge bull trend bar, but selling into the close. And the bulls still need follow through. So we have a breakout above a lot of bars to the left, but it's possible. If you look to the left, big down, big up, also 2 legs up, possible second leg trap in a trading range. We're testing the low of bar 18, where bears and bulls got trapped on bar 19. So we're retesting resistance at the high of bar 76. So 76, the bulls need to do more. They need at least one more bar. And when the bulls need one more bar, everybody knows that. The bulls and the bears both know that. So bears will sell, betting it's a second leg trap. It's even nested. 1, pull back 2. 1, pull back 2. Again at resistance. Overall, big down, big up. The down was bigger. Bears will sell here, betting the bulls will not get their one more bar. Because it's a breakout bar, they need follow through. and then they don't get it on 77. So bull breakout but no follow through. So bulls will be discouraged if a bull bought the close of 76, which is that red line. Let's say you bought the close, that's your entry bar, you're disappointed. So if you get the chance, you'll try to exit at break even. Maybe you scale in. Whether you scale in or not doesn't matter. If you can get out at break even, you'll take it. And then look at the tail on 78. The bar opened at the close of 77 here, rallied, tested the price where bulls got trapped, and then both bulls and bears sold. Everybody sold, and 78 is a breakout bar. Probably going lower. Overall, it's a trading range. We could test the bottom of the range. Maybe we'll test here. The bottom of the buy climax. And then 79, another huge bar, surprising. But the context for the bear breakout at 79 is not very good for a couple of reasons. First of all, look where we're testing. It's that low of Thursday that I drew. So we're testing support. The market's overall sideways. It's a big second leg down, leg one, complex two-legged pullback, leg two down to 79. This is climactic. It could be a second leg trap at support. It's also very late in the day. This looks like an exhaustive climactic bar and a bar that traders can buy. It's not the... When you're buying against a bar like 79, you're betting it's an exhaustive sell climax. And so what you might do is put a stop way down here, betting this bear breakout will fail. We're not going to get to the measured move. So you buy the close, scale in lower if it goes against you. But the hope is you get a bar. Bars like over here, 25, exhaustive, sell climax, market goes your way right away. That's what bulls are looking for. The logic behind that is if this is a trading range and you sold this low 2, you got a low 1, low 2, but let's say you sold up here, then the market gives you how many points? Maybe 60 points in 2 bars. The bears are going to take that. And then, of course, we're testing the bottom of the trading range. This rally was strong enough that there's buyers below. We're below it. We're at the bottom of the overall trading range. There's reasons to buy here, but with it being this late in the day, the bar being this big, not really ideal, maybe not worth it. And then 80, there were buyers into the close of the bar. Bull trend bar, probably going a little bit higher, but big down and then maybe big up. The market's overall sideways. And then 81, we rallied a little further. This was an exhaustive climactic bear bar testing support. Bears took profits and bulls bought. For always in today, the market was probably always in short coming into the day with the gap up high in the trading range, expecting resistance above yesterday's high. But always in, as I always say, is more of a trending concept. So in a trading range, better to think buy low, sell high. So if the market's high, you want to be looking to sell. So in that case, it's probably always in short. 7 might confirm that, but at some point it becomes a tight bear channel, always in short. And then all through here, it's always in short. Somewhere in here, maybe it's after 3, 4, 5 consecutive bull bars. The market might be always in long, but it's still not clear. We don't have a trend line break, big down, big up, so it might be an area to sell. But when you get the give up bar on 50, for me, that's when it's more clearly always in long. Okay to be long, probably going higher, like up here. And then you get the trend line break, it's still always in long, but on a retest, you want to look to exit your longs. So when you get a breakout like this, big and strong as it looks, it's probably climactic and the end of the bull move, 2 legs up, high in an overall trading range. So up here might be always in short. All you need is maybe 1 bar to confirm it, and then everybody sells. And then down here, huge bear breakout, but the context, big down, big up, big down. So down here, buy low, sell high. We're low in the range. It could be always in long. This is a sell vacuum test of support. Stop orders today. You could sell below bar 3, taking a chance, but not ideal. And then you could sell below bar 9, betting tight bear channel, and then a bear flag. We're probably going at least a little bit lower. But all through here really wasn't all that clear. It did look like a bear leg in a trading range, and the stop orders are not great. But at some point, when you decide the market's always in short and there's no reason to buy, you could sell below any bear bar, closing below its midpoint. Even here, 18 you could sell below, 19 you could sell below, 24 I mentioned, wedge bull flag or wedge bear flag, you could sell below 24, 25, 26, you could sell below any of these bars. And then nested low 2, 39 you could sell. 33 is a low 1, you could take it, but that's more of a scalp. You're expecting buyers below. And then through here, maybe it's sell to close, but the context, 3 legs down, breakout of a bear channel, probably a better area to take profits. You get a bar like 43, 44, you can get exit above 44, bulls will buy above it, and then it's maybe buy the close, buy above any of these bars, expecting a second leg. Always in long, you can buy above any bull bar up here. You get a test of the 24 high at the start of the channel. Better to look to take profits up here. 59 tested that price. However, it's still always in long, so you can sell for scalps, but nothing great for stop orders in here. And then 70, you could buy above it. Wedge, bull flag, probably going to test the top of the bull trend here at a minimum. 75, you could buy above for a scalp. And then I thought you could sell below 77 or 78, especially after 78 rallied to the close of 76 and then started to sell off. Sellers below here, sellers here for a test of the bottom of the range. But 79 was surprising. And for limit order trades today, I thought there were sellers above 1, micro channel, sellers above 6, consecutive inside bars, weak buying pressure, sellers above 9, micro channel, sellers above 15, bear breakout, weak, high 1, sellers above 20, sellers above the inside bull bar, any of these bars, minor reversal, you can sell above, tight bear channel, it's a breakout, micro channel, sellers above the first pullback, which was above 30, 31 outside bar, you could sell above, 35 was a bad stop order signal bar, didn't quite get triggered here, but you could sell above any bear bar, which would get triggered 38. And then here, maybe you can sell above 43, but the context was getting worse. Again, might be an exhaustive sell climax. So if you sell looking for a second leg, at some point, consecutive bull bars against you, the bears give up. And then you have this strong rally, strong enough for a second leg. You can buy below 47 for limit order buys below any of these bars. Consecutive inside bars, buy below. Weak, sell below 59, you could buy below, and if you get trapped, you have a chance to exit. High 1 above 61, you could sell above it. Low 1 below 65, after 2 legs down, minor reversal, you could buy below. 66, you could buy below, it's a weak stop order. And then same with 68, you could buy below. Bull breakout and follow through, first reversal will likely fail, buy below 72 for a second leg. And then you could sell the close of 76 on the retest during 78. For the day type today, I would call today a bear trading range day. Even though it was a bear trend for most of the day, you could call it a bear trend into a trading range. It was a bear trend for the first half of the day, but then about the midpoint, we rallied and then had this trading range. So if you look at it this way, market sideways all through here. And it's funny, you look at the daily chart over here on the left, and with just 2 bars left in the day, 10 minutes left in the day, this bar was closing on its low. It was a strong looking bear trend bar. And then, actually, let me switch this back. Maybe it'll look different. Maybe less of a tail. The point is, this was a bear bar closing on its low, but we know that when we look at this bar on a smaller time frame, it wasn't a very strong bear trend day, at least not all day. This was decent. This was a little climactic on 19, a little climactic here, but then all of this is hidden within the bar. So it might look like a trend bar, but we know it's mostly sideways in here. Where do we go tomorrow? Well, we tested that close of Thursday. Now we have a weak micro double bottom, stop order buy above today's high. The odds are there's sellers above, sellers at the moving average if we get above it. And for below, we can tell there's support. And just looking at these 4 bars on the daily chart, lots of overlap, prominent tails. Limit order market, there's buyers below the bar and sellers above the bar. As always, please feel free to leave questions in the comments and include timestamps for any question specific to this video. Alright, I hope everybody has a good rest of their night. Thank you for watching.